Hi everyone, welcome to the Buffett and Beyond Research Saturday ETF report. And this is October 12th, 2024. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And that's what we're going to show you, folks. And first of all, let's look at a chart of the QQQs. Now, this is the NASDAQ 100, and we are looking at down here, first of all, we have an upward trend, and it is showing up here, but the problem is we are right against the previous high, and this market has not, see these three lines right in here, have not been able to break through that previous high. But we still have a positive signal in our intermediate term signal. So we're waiting on that, and as I'm recording this Friday afternoon, so far so good. Now let's look at the oil and gas, and we use the XOP, oil and gas exploration. And the reason we're looking at that is because last week we talked about what a rise we were getting in that. And then this week it just fell back, and now it's trying to break through this red line, which is the 200-day moving average. You see, it did up here, and boy, it was looking very, very good. And then all of a sudden one day, price of oil and gas fell, and so did this ETF, and now we're struggling back up to get up there, but we have a good upward signal from the intermediate term indicator down here. And energy was the same thing last week. Boy, these two energy and oil and gas seem to follow one another very nicely, and boy, the energy was just rocking and rolling over here. This week, same thing happened. It looks exactly like the oil and gas, doesn't it? But this is a pretty good indicator up here. The problem is, see these vertical green lines here? This represents the volume of the ETF itself when it closes up for the day. The red line then, of course, is when it closes down for the day. But you could see that it really went up on strong volume up here, and the upward volume has been drying up as we've been going along. So that's not a good sign. But still, the intermediate term indicator is still pointing up, and this is trying to get back to its previous high over here, or previous recent high. But boy, if you look at this line all the way back here, yeah, it was really pretty. It was a line of resistance all along in here, went through it up here, and then fell down, just like on the oil and gas we just looked at. Now let's just look at the technology. XLK we use. It's the spider, or I should say the S&P group that put out the XLK, or put it together. And we have been on a nice run here. We had just a little bit of setback over here, but now we have on a nice run, and our indicator down here is pointing up. The semiconductors, pretty much the same thing, except they had a bigger fall in here a week and a half, almost 2 weeks ago, and bounced off that 200-day moving average, and now has been going up and is having a very nice day today that I'm recording this on Friday, and the indicator down here is pointing up. Now let's look at the transports, and I always say that the transports have to do well, because the transports tell us that if raw materials are being sent to the production centers, and then the production centers send to the retailers, because the retailers are seeing more buyers come in to buy more goods. So in other words, this is one way of indicating that the retailers are seeing something, and they start ordering the goods to be produced and shipped to them. And it has been doing a lot of nothing over the past several months in here, even though the market has been going up. And we hear about the new highs in the market, and folks, we're talking about inches. We're not talking about feet or miles. We're talking about little by little by little. And then all of a sudden, today or on Friday, this transport indicator just took right off. And boy, it's up very, very nice. As I'm recording, it's up 3.2% on the day, and it gapped up from yesterday. So it's not only up 3.2% for the day, but it's up more than that from the close on yesterday. And you can see down here, this really reversed itself and turned up. So this indicator had been pointing down, which was not too good for the market, and all of a sudden today it is taking off, or I should say the past 3 or 4 days, so almost all week, this ETF has been moving up, and boy, oh boy, good news came in that the number one, the PPI, the production price index, the production prices have gone down, well, not gone down, but they've only gone up 0.1% month over month. So that means inflation is at bay here, and this is why they expect more orders to be coming in. At least that's the way we're looking at it right now, because that news just came out. And let's look at our ETF sector stars. And I want to show you something over here. We talk about the clean surplus return all the time. So the ETF sector stars are our favorite ETFs. And out of those ETFs, we pick 3 or 4 of the best stocks in that ETF. And they all have to have an ROE, clean surplus ROE, of 20% or better. Now, you see a few are not there yet, or they have been and they're coming down a little bit. But you can see that also we have some 27 up here. We have a 36% up here. The average stock in the S&P 500 has a 13.5% clean surplus ROE. So you can see these stocks are much, much better. Well, they should perform better if they have a better ROE. Think of your bank account. Would you want to put your money in a bank account that's giving you 13.5% like the average stock, or would you like to put your money into a bank that's paying you 27% or 20% or 28%? That's the way you want to look at the clean surplus return on equity, because it's a comparable return on equity. So when we look at the QQQs, which are the NASDAQ 100 stocks, and that stock symbol is, or that ETF symbol is QQQ, it's up 20%, 20.4%, while the S&P is up 21.9%. The top stocks in this portfolio up 35%. They're up over 4% from last week. And if you're hedged, the hedge has only cost us less than 1% to be hedged, and we use an inverse ETF to do that. So we only have to use 10% of our money in order to do that and hedge 30% of the portfolio. Very efficient way of being able to hedge. Whichever one you're in, you're up 35%, folks. So if you're not hedging, you're up 35.1%. If you are hedging, you're up 34.8%. Doubling, we are talking about almost doubling the S&P 500. And of course, the names of the stocks are not here because those of you who subscribe to our newsletters get all those stocks in the ETF. Let us go to the top stocks in the NASDAQ 100, which is my favorite portfolio. And we have a dozen stocks in there. And the same thing. The QQQs up 20.4%, S&P up 21.9%. This portfolio up 39.7%, just about doubling the S&P 500, folks. And these are the stocks that you've heard of. You know, you have the Nvidias in there, you have the Netflixes in there. So they're Googles, the Apples, the Metas, so they're all in there. You'll get the names if you do subscribe to our portfolios, which so many of you do. Again, doubling the S&P 500, well worth any kind of subscription price. So, folks, we had a pretty good week, topsy-turvy week. Things are coming out, but we have another ending week, which is a good week. So go out, get your mind off it, go to the beach, walk on the golf course, go for a run. Be with your family on Sunday dinner. That would be nice. So, folks, go out there, forget about the market because it'll be here next week. And, folks, we'll see you right back here in a couple of days.